For tuning in this morning. Today we're talking about futures trading. A lot of great presenters on the docket today. I'm going to be specifically focusing on the E-mini futures, and a lot of the examples will pull from the E-mini S&P futures. So my name is Tim Racette. I blog over at eminimind.com, and we're going to be talking about using Fib retracements to day trade the E-mini futures markets. So there's a lot of good stuff to go over here in the next hour. We are recording the presentation. I'll do my best to keep my eye on the chat. If you do have questions, feel free to throw them in there. I'll try to answer them as we go. Now we're going to be talking about really all the aspects of day trading the futures markets. And so to highlight some of those things that we'll go over, we'll talk about the basics of market retracements and why they work. We'll talk about some ways that you can identify the trend and why that's really the foundational piece of day trading retracements. We'll look at the high probability setup that you can use essentially right after the presentation if you aren't trading already and you want to start practicing. We'll walk through where you can set profit targets, both fixed targets or trailing targets, trailing stops, if you will. Go through some of the psychological aspects, the differences between, some of the biases that you might come in to trading with if you're a newer trader versus what a seasoned trader, how they might process and think. We'll go through some of the trail stop techniques that I use, and then I got kind of 10 really key ideas or tips, if you will, from my own trading over the years that I think you'll find really helpful. So for those that are not familiar with myself, again, my name is Tim Racette, and I blog over at eminimind.com. I've been trading since about 2006 and went full-time in 2009. So I'm originally from the Chicagoland area, which is a really great place to be a trader because there's so much access to traders, the board of trade. At the time, there were quite a few prop firms. I got my start using Thinkorswim with Tom Sosnoff way back when it was only Thinkorswim and wasn't purchased by TD Ameritrade. I also spent a lot of time downtown at the Chicago Board of Trade, and was super fortunate to just be able to be exposed to the trading pit lifestyle and that career. And then at the time, being a fairly young fella, a friend and I who had been spending time down at the pits kind of shadowing some of the traders, they really encouraged us that the trading floor is probably not the place you want to be to grow a long-term career. At least the direction is moving more towards the trading screen. And obviously since the 80s, computers, traders have been trading on the computer. So those folks, down in the pits kind of introduced us to a couple of traders who'd been trading on the screen since the 80s, focusing on the E-mini S&Ps. And so by way of, just getting to know some of the people on the floor and them pushing us towards the trading screen, that's how I ended up, mostly focusing on the E-mini S&P futures, and then doing all of that on the screen. And there's definitely a lot of opportunities now, especially with obviously the technology, but also with the little bit increase in volatility and fairly low barriers to entry. So in addition to day trade futures, I also pair that with swing trading stocks and a little bit of options. I find that's a really nice balance. I actually began with swing trading stocks before I got into day trading futures. I've had the pleasure to speak at the Traders Expos all over the country, and spent some time doing some presentations for the CME group as well. Then outside of trading, I like to get outside. I'm a really big mountain biker. I like to explore the outdoors. I mentioned that I was originally from the Chicagoland area. I went to ASU out in Tempe, Arizona, and I currently live out in Scottsdale for about 9 months out of the year, and spend the summers elsewhere where it's a little bit cooler. So it's a pretty good arrangement. Arizona's a pretty great place to be. I love Chicago. Can't say that I miss the winters too much. So it's it's a pretty good setup to be, flexible with your um, mobility in terms of being able to trade from anywhere where you have a reliable internet connection. So um, I'm on all the usual places: Facebook, Twitter, lots of videos on YouTube that you can check out as well. So let's dive into some of my trading routine or trading style, and then let's get into some of the specifics of how I trade. We'll kind of walk through how to enter, manage, and exit a trade. So my general trading style, if you will, I'm a technical trader. I'm not really looking at news in terms of using that news to execute trades. And I'm not really looking to the fundamentals. So with the futures markets, that's a strong benefit. You can just focus on the technicals, and there's a lot of things built in to the charts that are just sort of a byproduct of a lot of that longer, uh, bigger picture fundamental data. So as far as how long I'm holding trades, when I day trade, it's typically a couple of minutes to an hour or so. If I'm in a pretty strong trending trade, that I'm able to trail my stop and work on scaling out of the position as I go. Sometimes it's longer than an hour, but by and large, I'm not looking to take 2 ticks at a time, and I'm not looking to hold my futures contracts for multiple days. So it's anywhere from a couple of minutes to an hour. And I primarily focus in the morning. The morning session where you still have the European markets open. You have that overlap between the US and European session. You have a lot of the volume. If you look at the 24 hours worth of trading data, you're going to see that volume spike right at the NYSE open. And for an hour or two, that's really where most of the trading activity occurs. So that's where I like to set my focus. When I began for about a year or so, well, maybe a year and a half, I traded the entire day, and I went back and took all my trades from that time period, and I grouped them into essentially 30-minute periods. So the first half hour, the second half hour, and by and large, I found that, okay, in the afternoon, I had winning trades, sure, but by and large, they were net zero. So the winning trades were offset by losing trades. You might be sitting there all day, you're a little bit bored. So I found that, well, most of my profitability is coming from the morning. So that's how I set on that time frame. Might be different for you. You might find that to work it into your lifestyle, trading the close is where you want to be. But just keep in mind that if you're going to trade after hours, you're not going to have the volume that you would in the trading session, and even more volume in the first couple hours of the regular trading session. So I'm a big proponent of continuing to trade when the markets are going my way. So when things are going good, it could be a couple of weeks, it could be a specific day, or even a couple of months. But when the trades are going my way and things are working well, I'm going to continue to trade, as opposed to saying, okay, I have a $500 profit target for the day, and if I hit that in one trade, I'm going to quit. Because what ends up happening is the days that trading is tough, if you have a fixed target like that, at least what I've found for me, if you have a fixed target and you try to work your work your trade and milk it and try to get to that target, you'll just end up a lot of times burying yourself or digging yourself a deeper hole. So I find that I would rather continue trading when things are going good and really, knock it out of the park with a lot of singles and doubles and maybe the occasional home run. And then if things aren't going so good, if I just can't get a good read on the morning, or I'm just not seeing things clearly, then I have no problem just stopping for the day or not taking a trade at all. And that's another benefit to trading in a specific time window. It does help contain your risk very nicely. I'm also a big proponent with, balancing or fitting in trading with your life. It's, if you want this to be a long-term endeavor or career, you want to be able to have some sustainability. And just like a diet fad or some new craze that's going to pop up and then disappear, if you create a trading routine that's just not sustainable, then you're not going to be able to do it for the long run. I used to wake up for the European Open and then go back to sleep and then wake up for the NYSE Open, trade all day. I did that for about a year and a half, and um, there's a lot of profitability that can be had at the European Open, but from a long-term sustainability standpoint, it's pretty tough. And then as for those that have kids or family or other things that they like to do, being on that rigid schedule is, uh, it can be a challenge. So finding ways to, work trading into your day job, or if you're trading part-time and working full-time or part-time, or maybe you're retired and you don't want to sit there in front of the screen all day long, just trying to find that balance is really beneficial. Um, like I said, I also swing trade stocks, which I find to be a nice balance of long-term investments as well. And then I'm a really fond of getting outside and getting away from the trading screen. Uh, you know, social, your spiritual life, things that you can get involved in, sports. I'm also a really big proponent of mastermind groups, or a mastermind group where you get together with folks who are not necessarily all like-minded. You don't want to just pigeonhole yourself with a whole bunch of traders, but if you get together with folks who, are thinkers and maybe some kind of leader in their field, it can be a really great way to get some different perspective, especially sitting here in front of the trading screen by yourself, going through your trades. It's just you and your thoughts. And so to get out, maybe that friend or that acquaintance that's a part of your group doesn't really understand trading, but they can ask you questions in a constructive way that really sparks some good thoughts and ideas. So, and then reading is also a fantastic way to build that creative mindset. And just remember that trading is a means to an end. So you know, you want to set some sort of bigger picture goal. And if it's to, create a net worth of of $1 million so that you can sit back and uh, invest that and just live off the dividends and interest, great. If it's to build some sort of lifestyle where you can travel, great. But come up with that end goal or paint that picture, and then, okay, how can I use trading to get me there? If you can live off of, you know, $4,000 a month, and you break it down to, okay, if I wanted to live entirely off my trading, well, it's $1,000 a week. If I've got a part-time job or I'm working full-time, what kind of trading returns and what does trading need to do to help me be that means to an end? And sometimes, we can gloss over those details. And if you kind of miss out on the why or that goal, when things start getting hard or get challenging, it's easy to jump ship. If you have that why or that goal in mind, then it's easier to, stay the course. So let's get into some of the nuts and bolts of my trading futures. So I always like to begin with identifying the trend. I think, setups are great. I'm not a huge indicator user, but you have to be able to look at the market, and I would certainly encourage you to focus on one or maybe two markets at a time. But if you're gonna, especially if you're newer, if you're gonna stretch yourself to 10 different markets, there's a lot of little things that you'll miss picking up on. So if you just focus on one market, maybe you're gonna start with the YM, and you're just gonna look at that market for the first couple months as you practice and get your feet wet and work on a strategy. That can be a really good way to hone your craft, and then you can expand from there. So it all kind of starts with identifying the trend. And we care about identifying the trend because it's a really good way to help define low risk entry points. From a structural perspective, we're all pretty familiar with the concept of higher highs and higher lows making an uptrend, and then lower highs and lower lows making up a downtrend. And just like in a lot of sports analogies, getting back to the basics is a really great way to build confidence so that you can eliminate maybe some of the hesitation in getting in the trade and pulling the trigger. If you really have a sound understanding of those fundamentals, just the simplest form of what you're looking at in the chart, it can be a really helpful way to build that confidence. So a really good exercise you can do is to print out a 5-minute chart of your trading hour session, so like of the YM or the E-mini S&P, and go through and mark the highs, mark the lows, and kind of reference how they relate to the prior high and low. So if you have a higher high, you just mark it HH, or a higher low, you can put HL, and you go through the day, you mark out those higher highs and higher lows, and then you can start to either highlight or draw a line through the trends that develop throughout the day. So you're going to have maybe periods of 15, 30 minutes, an hour where you have an uptrend, and then next 20-minute period or 30-minute period might be a downtrend. And you can start to identify different characteristics that make up a trending market versus a range-bound market. And when you can get a really good handle on what those look like, the differences that make up the two, then it can really help protect you in staying out of chop or situations where there's very high risk, and you can better be positioned when things are good for those low risk entry points. So identifying the trend, that's all well and good, but how do we know when a trend begins? Well, if we look at that market structure of, in this case, starting with lower highs and lower lows, lower high, lower low, markets in a downtrend. Well, at some point, we need to go from a downtrend to an uptrend. And that occurs when the market switches by breaking above a lower high and puts in a higher high. That's kind of the first sign that the downtrend is failing. And the trend then officially begins when we put in that higher low. So if we're in a situation with lower lows and lower highs, and we break that swing high, which has occurred over here, the next pullback is sort of the start of that new trend, at least the start that we can act upon. And so if you flip this upside down and you say, okay, well, we're in higher highs and higher lows, well, then the break of the swing low would be the very earliest sign that the uptrend is now breaking down. And so if you focus your sort of attention on this area where we're breaking a swing high or breaking a swing low, to be looking to place your trades at the start or close to the start of a new trend, that's when you're going to get, kind of the most bang for your buck. There's certainly times where, the trend is already going and we're going to jump on board. But if we can identify that, okay, we've been in uptrend for about 3 hours now, probably not the best time to jump into a long after the trend is so clear that everyone is able to identify that we're in an uptrend. And that's typically what happens with newer traders in chasing a market. They've got a bunch of indicators on their screen. They're waiting for different things to line up or cross or give a signal. They wait some more, they wait some more. Then all of a sudden, by the time they're entering the trade, the professional trader or the seasoned trader is already exiting the trade. And by chasing it, they're getting stopped out right at the start when they put their trade on. So you don't want that to be you. You want to be kind of, a good check for that is to be entering trades when things aren't the most clear. I know that sounds a little bit odd, but even if you think to like from a Warren Buffett, for example, he's entering stocks that are strong relative to the other stocks in that industry or sector when that industry or sector is down the dumps, when nobody's looking at it. The cryptocurrency is a big craze right now, and buying Bitcoin at 10 or 15,000 when it was up at 15, 16, 17,000, when everybody's talking about it and there's a lot of media coverage on it, is not going to be the most opportune place to enter. It's entering these various trades or investments when it's not hot, it's not in the news, people aren't talking about it. And so when you're looking at day trades, getting into a trade on a pullback when it's not necessarily a screaming trend is going to be a much lower risk entry point than waiting till everybody's talking about it and the media gets a hold of it and market's in a monster bear rally or a bull rally, excuse me, and then you jump in. Well, by that point, it's going to be too late. So let's talk about getting in the trend, getting in the trade. So what I like to do, we talked about waiting for that break of a swing high or a swing low. And just by looking at a simple chart, whether you could look at a 5-minute chart, you could look at a, even going down to a 2-minute chart, you could be on an hourly chart, but identifying, a prior swing high or a swing low that's been taken out is kind of the first step for identifying the start of a new trend so that you can get into that trade. What I like to do is just use a very simple Fib retracement tool to get in on a 50% pullback. And this concept is pretty basic. 50% is not necessarily a Fib number. I'm just using the tool to get into the trade. And in the trading pits, what the floor traders would do is take the first hour. They look at the high for the first hour and then the low for the first hour, cut that in half, and then look to get in the market when it pulled back to that halfway point or the 50%. There's quite a few algorithms and hedge funds, computerized trading firms and the like that use Fibonacci retracements, and particularly, retracements to 50%. And so being an individual trader, someone who trades from home, you're not trading 100 ES contracts. Most of us aren't, who are trading from home. We're looking to get in the trend or jump on board with those algorithms, those JP Morgan Chase that's down the trading pit, that's putting on a bigger, longer term position, that's actually sort of building or making the trend. You know, if a big bank's coming in to put on a position for a client, you know, you don't just go into the trading pit and put on 1,000 contracts. You have to build that position in smaller chunks. And so you get a little bit of a trend developing. Let's call it an uptrend. Market pulls back a little bit. That gives that floor trader the opportunity to put on more contracts for that client. In the case of a downtrend, if a hedge fund has a big long portfolio and they want to you know, build in a hedge around that and short some of the S&P futures contracts, you're not going to come in and put 10,000 contracts on at once. So what you start to see reflected in the chart is the market moves down and then it rallies a little bit. That gives the opportunity for more contracts to be put on for that hedge. Market that kind of pushes the market down again. It bounces, another opportunity to put on contracts. So this sort of stair-stepping approach is kind of built into the market. And when you couple that with a lot of the computerized trading firms that are out there, especially in the Chicago area, that are running these kind of algorithms that need, you know, quantifiable numbers, specific highs and lows on the chart that they can use in their equations, you start to see what can sometimes be you know, a little bit eerie or magical looking when the market pulls back to a 50% and then reverses. But there's a lot of things that are built in as well with just the human behavior, the fear and the greed that also come into play with trading retracements. So drawing up that 50% retracement, placing your order at the 50, and looking for that trend to resume. So you're essentially entering the trade, in this case, you know, entering a long position as the market is coming down. So you might be saying, okay, well, market's coming down. Why would I want to enter the trade? Well, if you think of the 50% area as sort of a train station, if you will. Well, when the train is coming into the station, it's typically going to be slowing down, losing steam, and there's a good chance that if that's the end of the line, that train is going to change direction. And so by entering in and around a 50% retracement, when you've already identified that the trend is essentially going in the other direction, so the trend is up, but the market's pulling back, temporarily moving down, it's typically going to be slowing down or losing steam. So by the time you're getting in, there's other buyers and momentum being built in that original direction of the larger trend, in this case, going up. So when it comes to managing the trade, placing stops and targets, what I like to do is place my stop outside of the 61.8, and so which is a Fib retracement number, a Fib number. So using the 61.8 is just a helpful way to kind of keep things relative to the range of the market. So if volatility is really low, you might have a very small distance between the 50% and the 61.8. If volatility picks up, you might have a larger distance between the 50% and the 61.8. So in that way, it's very flexible and malleable to different market conditions. What you don't want is to be so structured and have so many indicators or tools that are so specific to that market and that volatility and that condition that as soon as things change, as soon as we go from a uptrend to a sideways market, or as soon as volatility goes from the low teens to the mid 50s, if things fall apart, well, it's again not a very sustainable strategy. So, and then the other area as far as managing the trade goes, stop outside the 61.8, and then targeting the negative 23.6 is a really useful area. Essentially, you're looking at a move 20% beyond, in this case, its high. And a lot of times you'll get reversals there. Sometimes they're short term, and we'll talk about some ways that you can stay in trades longer, staying the winning trades longer. So 3 tools that I like to use. We already talked about the Fib retracement tool. None of this stuff is proprietary. So whether you're using Thinkorswim or NinjaTrader, TradeStation, it's all available across the different platforms. So a basic Fib tool. I also find that a Heikin Ashi candlestick study is really useful. And then the other tool that I find useful, or a way of viewing the chart, is tick charts. And we'll talk a little bit about each of those here and how I use them together. So the Fib tool, that's pretty basic. But as far as the Heikin Ashi candlestick goes, it's similar to a traditional candlestick. It's just another way of viewing the market. Just like as we lay on a Fibonacci retracement, it's just a filter for adding some structure to the market itself. So if we're going to put on our Fib retracement glasses and look at the market through that lens, that helps us filter out some of the noise and develop that edge. So a Heikin Ashi candlestick is a variant of the traditional candlestick, except for the open. So here's the traditional, open, high, low, close. Sometimes the bars are filled, sometimes they're colored rather. Sometimes they're just black and white. But open body for a bullish move, and then filled body for a bearish move. And there's a lot built into the candlestick itself, as far as what occurred during that period. And so Heikin Ashi candlestick, instead of using, so we have the open, high, low, close. Instead of using the open price for every new candle, the new candle just starts at the midpoint of the prior candle. And so this is the same chart, traditional on the left, Heikin Ashi on the right. And the Heikin Ashi, just, similar to the Renko bars, it just smooths out the trend a little bit. I only use this for really small time frames. So when it comes to, I mentioned that tick chart, instead of a 5-minute or a 15-minute or even like a 2-minute, if you use what's called a tick chart, and that's a candle that's forming after a certain number of trades complete. So in a lot of cases, I'm using a 512 tick chart, and that's just a helpful way, again, to kind of break up the market a little bit from the standard 1, 2, 5, 10, the time-based charts. And so cleaning up the chart a little bit to help your eyes process and identify the trend a little bit quicker is just a helpful way to kind of give you some clearer direction with those color-coded bars, and help make the trend changes a little more obvious. So when it comes to setting profit targets, if we're going to be entering at a 50% pullback, what we don't want to do is be getting in a trade. Let's say the distance between our 50 and our 61.8 is 2 points. So you give a little wiggle room, you give it a tick on the one side and 1 or 2 ticks on each end. So let's say we've got a 3-point distance between our entry and our stop. Well, you don't want to be taking the trade off and end up with a trade with a a 2-point gain when you're risking 3 points. At least as an individual trader, it's difficult to scalp a couple of ticks or a point when you're going up against computerized hedge funds that are they have servers co-located next to the exchanges. They're making thousands and thousands of trades with thousands and thousands of contracts over the course of a day. So our edge or advantage is in capturing relatively larger moves than our risk. So a couple of places that I look to take profits. We already mentioned the negative 23 as a target, and typically that negative 23, as it relates to the 50 and the 61.8, is going to be about 3 or 4 times the distance from the 50 to the negative 23 compared to the 50 to the 61.8. So if you're going to shoot for somewhere in the 3-to-1 reward to risk ratio, the negative 23 is a great spot to look. If you're risking 3 points, you could throw out a 9-point target. It's super important, I find, to practice with multiple contracts. So I find that folks do much better in the long run if they spend some time, either on sim or perhaps trading. Now we have the micro ES, trading that, like say trading the micro ES with 3 contracts so that you can practice getting out of trades, and more importantly, staying in those winning trades and not getting out for 1 point or a couple of ticks just because you're scared. So you could have a smaller first target of, say, the size of your stop. So if you're using a 3-point stop and you want to have a 3-point target on one of the first of the 3 contracts to kind of reduce some of that risk, that's about the smallest I would go for a first target, is the 1-to-1 with the size of my stop. Because if you have 10 contracts and you take 8 of them off for a point when you were risking 3 points, those last 2 contracts have to go a long way just to get your total position to a 1-to-1 reward to risk ratio. So if you can stay in as many contracts as you have for as long as you can, then you'll be able to build out that reward to risk that's 2, 3, or 4-to-1 times reward times your relative to your risk. So having a fixed target, let's say you've got 3 contracts and you're going to take one off at the negative 23%, and let's say you take you do have some smaller first target of 3 points, sticking with the 3-point stop example. Well, that leaves you a contract that you can have some flexibility with in trail. And so 2 of the trail stop methods that we're going to look at here, the 2 that I use for both day trading and swing trading. The first one is a little bit conservative, and it's just trailing, if you're long, trailing below the swing lows as the market's going higher. And if you're short, trailing above the swing highs as the market's going lower. And then if things really get cooking and moving fast, or if volatility is really high, so the market's just moving in really big ranges, trailing each candle is a more aggressive approach, but it's a really good way to be able to lock in gains as things are moving quickly. So if we take a closer look at trailing the swings, and that's just below swing lows for a long or above swing highs for a short, essentially what you're doing is just letting the market come up It makes a new high for the trade and pulls back a little bit, and then goes up and makes another new high. And then you can just bring your stop up underneath that swing low. Makes a pullback, makes another new high, bring your stop up underneath the next swing low. And the reason that the swing lows in a long scenario is where you want to place your stop. If we think all the way back to the beginning of our talk today, breaking a swing low or a swing high is the early signal that a trend is changing. So if you're in a trade, you want to be able to get out when the trend is showing its earliest sign of breaking down. And so that's why using that swing high and swing low is a great place to place those stops. So you're going to have certainly some room between where price is and where the swing low is. And sometimes that's a bit much, especially if the market really gets ripping. And so, you know, having multiple contracts allows you to have multiple exit points, which is super beneficial. And so if the market gets moving quickly, or if you've got, let's say you have 2 contracts left, the trade's going your way, and you want to trade one conservatively and trail one aggressively, you have that option. So the more aggressive trail stop technique is to trail each candle. And again, if you're swing trading, and you can do this on a daily chart, if you're intraday, it could be a 5-minute, a 15-minute chart, whatever time frame you're using, you can trail each candle, or you can trail the swing highs and the swing lows. So using that premise, if this is our ripping trade, say we get in down here above this little dragonfly doji candle, and we start with the stop below the low of that candle, or pretending, let's say that it's just below the 61.8, and all of a sudden the market gets ripping really fast, we can just take our stop, and every time a new candle starts to form, just put the stop underneath the prior candle's low. And the new candle forms, makes a new high, just keep trailing that prior candle's low until it gets taken out. And there's a lot of situations where the market gets moving really quickly, especially on the smaller time frames, and instead of just hitting the flatten button and closing out of the trade, if you just kind of do your best to drag your price up on the trade ladder on your dome, and just kind of follow along, maybe a tick or two below each candle, even if you're just eyeballing it, you know, you can come away with a lot more profit out of the trade than if you just, you know, get scared, close out the trade. And it also helps to, from a psychological perspective, if you only have a fixed target on every trade, you're always capping your gains. It's like you know, batting into a cage. If the end of the cage is only 50 feet, you're not gonna hit the ball more than 50 feet ever. But if you have, you know, a complete field at your disposal, you're not always going to hit a home run. If you always swing for home runs, there's a lot of times you're going to miss completely. But if you just hone that craft and have a nice smooth stroke, a nice clean entry that you're repeating over and over again, there's going to be times where you connect and where you hit that, make good contact, you catch that great trade, and by trailing your stop, it gives you the ability or the opportunity to catch that larger move. And that's what becomes really beneficial over time. So again, if you're looking at this could be a 512 tick chart, or it could be a big, you know, in this case, daily chart. So it doesn't matter if you're using the small time frame intraday or swing trading. Trailing each candle or trailing swings is a great approach. Intraday, yeah, I am a fan of the 5-minute chart. If you get so small, like down to the 1 and 2 minute, um, sometimes you end up with a lot of noise, and that noise can kick you out of a trade. Now, I did mention the 512 tick chart. That's the equivalent of a very small time frame. So the smaller time frames, until the trade really gets ripping, you want to kind of be conservative with your stop. And so let's move to that and talk about how you can stay in some of those winning trades longer. So great segue there, Joel. If we are patient at the start of the trade, especially for any of you who've traded the E-minis, price can kind of sit around your order, chop around your entry. There's been plenty of times where I've had trades come 1 tick away from my stop and then turn into a strong winner. Now, obviously, the best trades or the strongest ones are the ones that come to the 50 and then are met with support or resistance and take off. But there's also plenty of times where I do take heat on the trade. And so if you're patient at the start, it can really help to make those trades, those winning trades, give them a chance to develop. And so what I like to do is wait for, if this is my retracement drawing, and if I'm calling this white line, the high from when I drew up the trade, I like to wait for that high to break before starting to trail my stop. So if I was going to trail aggressively, I was going to trail each candle aggressively, I would wait till we break that swing high, and then I would come in and start trailing each candle. Another thing that helps me stay in trades longer is to not trail inside bars or candles that don't make a new high. So you can kind of see this candle here makes a high, but then the next 4 bars don't. So just leaving your stop below that initial bar, letting the inside bars form, or kind of the bull flag, if you will, and then bringing the stop up again once we start to make a new high is an approach that will allow you to stay in some of those trends a little bit longer. And then if you can keep one contract, at least one contract, to trail conservatively, you can stay in the trade longer by just trailing the swing lows. And sometimes the market will make a move and then pull back to its next 50%, but then sometimes it doesn't. And so by trailing your stop and already being in the trade, you don't have to put on new risk to get into the trade again, or risk the trade not pulling back. So that's why I'm a big fan of scaling out, as long as the risk to reward per contract is good. So if you have 3 contracts, you don't want to take one of the contracts off, like I said, for a point if you're risking 3 points. So one of the last things I want to talk about are some of the metrics that I use to look at my trades. I find that looking at trades in groups, 20 or 30, is more beneficial than looking at individual trades. And you never want to make major course corrections based on one trade, because it could easily be an outlier. So obviously the more trades you have in your data set, the better. But at minimum, 20 or 30 trades over the course of a week is going to give you a better picture of what's going on. So the metrics that I like to use are what's called the R multiple, or looking at the reward to risk. So going back to the 3 contract example, if you're risking 3 points and you took 3 points of profit, your reward, 3 versus your risk, 3, gives you a 1-to-1 R multiple. So if on the whole position you took out 6 points of profit and you risked 3 points, your R multiple is 2-to-1. And that's a really good way to get a gauge of how both your individual trades are doing and then how your trading as a whole is going. It's when you look at kind of the metrics of, okay, my average winner, my average loser, as far as a dollar amount, and your winning percentage and your losing percentage, you can manipulate those numbers to make your strategy work. Not manipulating the data per se, but what do I need to do with my trades? Do I need to extend my winners? Do I need to reduce my losers? Do I need to increase my winning percentage? And so the R multiple can help you kind of paint that picture. And the second thing that I look at is the expectancy. And this is taking into account, the average winner and the average loser and their win rates. Essentially, you're just getting the average trade. I want to know, okay, out of my last 50 trades, on average, when I account for the losers and the winners, what's my average trade? And obviously, you need that to be a positive number if you want a positive outcome. But you also need that number to be large enough to where you can account for things like slippage, which really doesn't happen too much in the futures markets, especially in like the E-mini S&P, but it will happen. Occasionally you'll get a tick or two worse entry if things are moving fast, especially if it's a stop order. And so looking at your average trade, it's kind of a good barometer for, okay, if I know my expectancy, if I'm averaging 3 points per trade per contract, and all of a sudden I start averaging 1 point for the week, okay, things are worse than my average. Or if volatility kicks up and all of a sudden I'm averaging 5 points per trade, I know that, okay, I'm above average. So it can help kind of steer or keep you headed in the right direction. And the last thing I like to look at is the max drawdown, just to get an idea of, okay, what's the worst period that I've experienced, so that if I do start to head in a little bit of a downward trend, I can kind of know what to expect and brace myself for something that might be out of the ordinary. And so a small drawdown's not going to really do much emotionally. But if I start to see it increasing a little bit, I can reference, okay, what are the biggest drawdown periods that I've experienced? And then that can help, again, kind of course correct the ship, if you will, or pull back if I need to slow down my trading to get through a challenging week or couple of weeks. I have that reference point. So as far as, all of these examples are really pertaining to futures, but the same thing really does apply for swing trading as far as, or for stocks, swing trading stocks, options, as well as day trading stocks. You can use the same swing trail stop approaches. You can use the same Fibonacci retracement entries. You can use the same targets of 3 to 1. And so being able to move your trading from one market in one time frame, your strategy, to another market in another time frame, is really an important sign of something that, again, is sustainable. And that's what we're looking for, long-term sustainability. So 10 things that I find super important, that I've kind of have really resonated with me over the years and helped me get through ups and downs. Just reminding myself that the market can always go higher and it can always go lower. So even if it seems like the range on the day is big, it can always go more. And so that kind of keeps me just reminded that, if I'm trailing my stop, I don't want to cap my gains. It's also important not to tighten stops too quickly. We've talked about with the ES especially, you can get kicked out of a trade and then it rips. So if you can be patient at the start, it's going to do a lot of benefit for the long run. It's okay to give up the small winner to get to that big winner. I find that it's more important to maximize the winning trades, like the amount per trade and not necessarily the number of winners. I'd rather trade less and milk that trade versus trying to trade more, because as you trade more, you take on more risk, and then over the long run, it can hurt you. I find it important to trade the same way each time, especially from a psychological standpoint, to be able to execute the same way. It's important to really analyze the numbers, put your trades into a Excel spreadsheet and just look at those metrics we talked about, R multiple, drawdown, and expectancy. The probabilities are really where it's at when it comes to those numbers and the statistics. Trading less leads to more profits. That's definitely something I've experienced over the last 10, 12 years. And reminding myself that I don't have to make a trade today is really helpful to remain clear-headed and focused. Because if you put that pressure on you that you have to trade, you start to manipulate things, or at least manipulate the way you see things. And then finally, keeping it simple and trying to be as hands-off as possible. There's obviously going to be a subjective layer to our trading, but if we can keep things as simple as possible, when the market starts moving really fast and things get crazy, we don't have that many moving parts, so we can easily adapt or change directions. Getting in and out of trades is easy to do, and we don't have a million different indicators or things that have to line up in order for us to place a trade. And then one final note I always like to leave people with is, there's really no shortcuts or substitute for that time in front of the screen. You can watch someone else trade or read about someone else's trading, but that confidence is going to come from you building belief in your trading strategy. And you build belief in that trading strategy by seeing it work over and over again, or at the very least, seeing a statistical set of 50 trades, 100 trades that you yourself have taken or watched, and you can see trades that work, trades that don't, and build that confidence in some of the nuances that occur when you're trading and the observations that you make. If by and large, the market is pulling back to retracements and then continuing the trend, that can help give you confidence to not hesitate to place your trades and build some of that long-term sustainability. So if you work smart and you're patient and you practice staying disciplined, that can really be a strong foundation for a long-term trading career. So you can